March 26, 2021. Manhattan. The financial district hummed with its usual morning energy, traders clutching coffee cups, screens flickering with numbers that seemed to dance with promise. But in a nondescript office building, something impossible was happening. A family investment fund, managing $36 billion, was simply gone. Vanished in 48 hours. $20 billion. Gone. Just like that. How does $20 billion disappear in 2 days? How does a man who built an empire from $500 million lose it all in less time than it takes to read a weekend newspaper? Turn off the lights, close your portfolio, and plug in your earphones. Join us tonight as we delve into the dark side of the markets. The spring air in Manhattan carried that familiar mix of exhaust and possibility. Coffee shops overflowed with the usual crowd. Analysts scrolling through reports. Portfolio managers checking overnight movements from Asian markets. The cherry blossoms in Central Park were just beginning to bloom. It was the kind of morning when fortunes felt secure, when the carefully constructed portfolios of the wealthy seemed as permanent as the granite facades of Wall Street itself. But 12 blocks north, in an office that most people would never notice, a different kind of spring was ending. The artificial spring of a market manipulator. The carefully tended garden of inflated stock prices was about to wither and die. The story begins 8 years earlier, in the aftermath of Disgrace. Hwang, known to everyone as Bill, had built his reputation as a protégé of the legendary Julian Robertson, Tiger Management, the stuff of hedge fund legend. But in 2012, that reputation crumbled. Insider trading accusations, stock manipulation charges. The Securities and Exchange Commission banned Hwang from managing other people's money. His hedge fund business. Over. At 50 years old, watching a career dissolve. But Hwang had something the regulators couldn't take away. His own money. Lots of it. And a burning need to prove that he could still move markets. Still make the impossible happen. So in 2013, he did what wealthy men do when they want to keep playing the game. He created a family office, Archegos Capital Management, a private investment vehicle managing only his own wealth. No outside investors, no regulatory oversight of his day-to-day trading. Just Bill Hwang, and $500 million. The name itself was telling. Archegos, ancient Greek for one who leads the way, the leader of the charge, the first into battle. And battle it was. For the first 3 years, Archegos looked like any other successful family office. Steady growth, disciplined investing. By 2016, that initial $500 million had grown to nearly $4 billion. Hwang presented himself as a fundamental investor, someone who bought companies he believed in, held them for years, let time and patience do the work. Credit Suisse, one of his prime brokers, steadily improved their internal credit rating of Archegos. More assets meant more stability. More stability meant more borrowing capacity. The virtuous cycle of wealth building. But something was changing inside Bill Hwang. Perhaps it was the memory of those insider trading accusations. Perhaps it was the sting of being banned from managing hedge funds. Or perhaps it was simply the intoxicating realization of just how much money he now controlled. By 2020, as the world locked down and markets gyrated wildly, Hwang made a decision that would change everything. He abandoned his careful, long-term approach. No more 3 to 5 year investment horizons. No more patient fundamental analysis. He would become a trader, an active, aggressive, relentless trader, and he would focus all that firepower on a handful of stocks. The transformation was swift. Almost overnight, Archegos shifted from diversified long-term investing to concentrated, constant trading. Nearly all of the fund's capital, now deployed in just a few names. Stocks that Hwang believed he understood. Stocks that he thought he could control. ViacomCBS, the media conglomerate, Discovery Communications, the cable network operator, a handful of other carefully chosen targets, companies whose stock prices, Hwang decided, didn't reflect their true value. Or rather, companies whose stock prices he decided he could make reflect whatever value he wanted them to reflect. The mechanics were elegant in their simplicity. Hwang would buy, and buy, and buy, not just shares, but derivatives, total return swaps that gave him massive leverage. For every dollar of his own money, he could control 5, sometimes $10 of stock. But buying alone wasn't enough. Hwang developed what prosecutors would later call manipulative trading strategies. He would time his purchases for maximum impact, buy heavily just before market close, driving up the closing price, create artificial signals of demand, make it look like institutional investors were suddenly fascinated by these stocks. The beauty of the scheme was its self-reinforcing nature. As prices rose, Archegos' positions became more valuable. As positions became more valuable, Hwang had more borrowing power. More borrowing power meant more buying capacity. More buying meant higher prices. Round and round it went. A perfect circle of artificial demand, creating artificial value, creating artificial wealth. By early 2021, the strategy was working beyond Hwang's wildest dreams. His portfolio had grown to over $36 billion. Not bad for a man who'd been banned from the hedge fund industry less than a decade earlier. But there was a problem. As Archegos' positions grew larger, his prime brokers began to notice. Credit Suisse, Morgan Stanley, Goldman Sachs. These weren't small trades anymore. These were massive market-moving positions, the kind that made risk managers nervous. So they began imposing limits, trading caps, position size restrictions, the very controls that might have prevented what was coming. But Bill Hwang had not spent 8 years rebuilding his fortune to be stopped by nervous bankers. When the prime brokers imposed limits, he simply lied to them, repeatedly, systematically, materially false and misleading statements about Archegos' portfolio composition, about the fund's risk profile, about how concentrated their positions really were. Patrick Halligan, the fund's chief financial officer, helped craft these deceptions. They would tell Credit Suisse one story about their holdings, Goldman Sachs another, Morgan Stanley a third. Each bank believed they were seeing the complete picture. None realized they were seeing carefully constructed fragments, designed to hide the true scale of Hwang's concentration. And so the machine kept running. More leverage, more buying, higher prices. By March of 2021, ViacomCBS stock had risen dramatically. Discovery, too. The market seemed to validate Hwang's genius, his ability to identify undervalued companies, his skill at timing the market. But it was all an illusion, a house of cards built on artificial demand. And like all artificial things in the financial markets, it was fragile, incredibly fragile. The weather on March 22, 2021 was unseasonably warm for late March. 68 degrees in Manhattan, the kind of day that made people think of spring cleaning, of clearing out old things, of fresh starts. It was the perfect day for ViacomCBS to announce they were issuing new shares, a seasoned equity offering in the language of Wall Street. The company would sell additional stock to raise capital, standard corporate finance, nothing unusual. Except that when you're running a massive stock manipulation scheme, new share issuances are death. They increase supply. They signal that even the company thinks the current price might be too high. They destroy the illusion that rising prices reflect genuine demand. Bill Hwang watched the announcement hit the newswires. He understood immediately what it meant. The artificial demand he'd created was about to meet natural market forces, supply and demand, the most basic law of economics. And he was about to lose. But Hwang didn't surrender. Not yet. He doubled down. On March 23rd, the day after the ViacomCBS announcement, he directed nearly $1 billion in additional purchases. ViacomCBS, Discovery, the other names in his concentrated portfolio. $1 billion in a single day, a desperate attempt to control prices, to prevent them from falling, to maintain the illusion just a little longer. It was like trying to hold back the tide with bare hands. March 24th dawned grey and cool. The spring warmth had vanished overnight, replaced by the kind of raw wind that cuts through even the heaviest coat. The weather matched the mood in Hwang's trading room. This was it, the final attempt. Hwang deployed every remaining dollar of cash, used every bit of available trading capacity, bought with the fury of a man watching his empire crumble. But the market is bigger than any one person, bigger than any scheme, bigger than any amount of money. And on March 24th, the market decided that ViacomCBS was overvalued, that Discovery was overvalued, that the prices Bill Hwang had so carefully inflated were artificial. When the closing bell rang at 4 p.m., Archegos faced something that had once seemed impossible. Margin calls. Massive margin calls. The prime brokers wanted their money back, immediately. Credit Suisse, Morgan Stanley, Goldman Sachs, Deutsche Bank, Nomura, UBS. They'd all lent money against Archegos positions. And now those positions were collapsing, fast. The math was simple and terrifying. When you're leveraged 10 to 1, a 10% decline in your portfolio wipes out your entire capital. When you're leveraged even higher, well, you don't just lose your money, you lose other people's money too. Billions of dollars. Gone, not gradually, not over months or years, in hours. As it would transpire, the mechanics of Hwang's scheme were both sophisticated and blindingly simple. Like most great frauds, the basic concept could be explained to a child. Step 1. Concentrate enormous amounts of capital in a small number of stocks. Step 2. Use derivatives and leverage to amplify that concentration. Step 3. Manipulate the timing and size of your trades to create artificial price movements. Step 4. Lie to your lenders about how concentrated and risky your positions really are. The total return swaps were the key innovation. These derivatives allowed Hwang to gain exposure to stocks without actually owning them. For every dollar of Archegos capital, he could control $5 or $10 worth of stock movement. When prices went up, the profits were magnified, but when they went down. The leverage worked both ways. Prosecutors would later identify the specific techniques Hwang used to manipulate prices. He would buy heavily just before market close, a practice called marking the close, to artificially inflate the day's final price. He would coordinate trades across multiple prime brokers to maximize market impact. He would time purchases to create the illusion of sustained institutional demand. Each technique was designed to make other investors believe that legitimate demand was driving prices higher. Pension funds would see the rising prices and think they were missing out. Mutual funds would follow the momentum. Individual investors would chase the gains. And all the while, the actual demand was just Bill Hwang, buying from himself, in an ever more complex shell game of artificial transactions. The lies to the prime brokers were equally systematic. When Credit Suisse asked about portfolio concentration, Archegos would provide carefully crafted reports that understated their positions. When Goldman Sachs imposed trading limits, Hwang would simply shift more business to Morgan Stanley, without telling either bank about the other's limits. No single lender saw the complete picture. Each believed they were taking reasonable risks with a successful family office. None realized they were enabling a massive market manipulation scheme. The ViacomCBS seasoned equity offering exposed the fundamental weakness in Hwang's strategy. When a company issues new shares, it's sending a signal. Management thinks the current price is fair, or even generous. They're willing to dilute existing shareholders. They're choosing to raise capital now rather than wait for higher prices. For a stock trading on genuine fundamentals, a new share issuance might cause a temporary dip, followed by recovery as the market absorbs the additional supply. But for a stock trading on artificial manipulation, new supply is catastrophic. The additional shares didn't just increase supply, they shattered the illusion that rising prices reflected growing demand. They reminded the market that stock prices are supposed to reflect underlying value, not the whims of a single massive trader. And once that illusion was broken, once other investors realized that ViacomCBS and Discovery weren't rising because of fundamental strength, the collapse was inevitable, swift and merciless. The prime brokers found themselves in an impossible position. They'd lent billions against positions that were now worth significantly less than the loans. Archegos couldn't meet the margin calls. The fund was effectively insolvent. But the losses weren't just Hwang's. Credit Suisse alone lost over $5 billion. Morgan Stanley lost nearly $1 billion. Nomura, UBS, Deutsche Bank all faced massive write-downs. Money that had seemed safely lent to a successful family office simply vanished. The irony was perfect. Bill Hwang, banned from managing other people's money, had found a way to lose other people's money anyway, just more indirectly, through the prime brokerage system that was supposed to manage risk, through the lies and manipulation that turned prudent lending into reckless speculation. The final tally remains uncertain. The Wall Street Journal reported that Hwang lost $8 billion in 10 days. Bloomberg put the figure at $20 billion in 2 days. But no one, not even Bill Hwang himself, knows the exact amount that disappeared when Archegos collapsed. What we do know is that it was one of the largest single trading losses in financial history, larger than Nick Leeson's destruction of Barings Bank, comparable to the London whale losses at JP Morgan Chase, a monument to the dangers of concentration, leverage, and deception in modern markets. The legal consequences followed with the grinding inevitability of federal prosecution. On April 27, 2022, more than a year after Archegos collapsed, FBI agents arrested Bill Hwang and Patrick Halligan at their homes. The charges were comprehensive: racketeering conspiracy, securities fraud, wire fraud, market manipulation, a 59-page indictment that laid out the manipulation scheme in meticulous detail, the false statements to prime brokers, the coordinated trading designed to inflate prices, the systematic deception that enabled the fraud. Both men initially pleaded not guilty. Hwang maintained his innocence. His lawyers argued that he was a legitimate investor who'd simply made bad bets, that the losses were real. But the manipulation allegations were overreach by prosecutors looking for someone to blame for market volatility. But two former Archegos employees told a different story. They pleaded guilty. They cooperated with prosecutors. They provided the inside view of how the manipulation actually worked, day by day, trade by trade, lie by lie. The trial began in the summer of 2024. 9 weeks of testimony, detailed analysis of trading records, expert witnesses explaining how legitimate investing differs from market manipulation, former employees describing the pressure to inflate prices, and the lies told to hide the scheme from lenders. The defense fought hard. They argued that Hwang believed in the companies he was buying, that ViacomCBS and Discovery were genuinely undervalued, that concentrated investing, even highly leveraged concentrated investing, isn't fraud. It's just aggressive portfolio management. But the evidence was overwhelming. The timing of trades, the coordination across prime brokers, the false statements about portfolio concentration, the desperate attempts to prop up prices as they began to fall. The pattern was too clear, too systematic, too manipulative to explain away. In July of 2024, the jury delivered its verdict. Guilty on all counts. Bill Hwang, market manipulator. Patrick Halligan, co-conspirator. Both men convicted of racketeering conspiracy, securities fraud, and wire fraud. The sentencing came in November. 18 years in prison for Bill Hwang. 3 years of supervised release. More than $9 billion in restitution, though how much of that will ever be collected remains unclear. Patrick Halligan awaits his own sentencing, scheduled for January 27, 2025. The conclusion to a legal process that began with a phone call on a spring morning when $36 billion simply disappeared. The regulatory aftermath spread far beyond the courtroom. Credit Suisse, already weakened by other scandals, faced a $387 million fine from US and British authorities. The bank had failed to properly monitor Archegos, failed to understand the risks they were enabling, failed to protect their shareholders from the consequences of Bill Hwang's manipulation. Credit Suisse wouldn't survive long enough to fully absorb the lessons. UBS acquired the bank in 2023, inheriting the Archegos fine along with the rest of Credit Suisse's troubled legacy. The Archegos collapse sparked broader questions about family offices. These private investment vehicles, managing the wealth of ultra-rich families, operate with minimal regulatory oversight. They don't have to register with the SEC, don't have to file public reports, don't face the same scrutiny as hedge funds or mutual funds. But as Archegos demonstrated, they can grow large enough to move markets, large enough to threaten financial stability, large enough to cause billions in losses to major banks. The regulatory framework, designed for a simpler time, hadn't kept pace with the concentration of wealth in private hands. Calls for reform echoed through congressional hearing rooms, greater oversight of family offices, more transparency in the derivatives markets, stricter limits on leverage, the usual post-crisis ritual of promising that this time would be different. But the fundamental dynamic remains unchanged. Wealthy individuals will always seek ways to amplify their market power. Banks will always compete to provide that amplification. Regulators will always struggle to keep pace with financial innovation. And somewhere, in some nondescript office building, the next Bill Hwang is probably studying the Archegos case, learning from its mistakes, preparing to test the market's defenses once again. The spring of 2021 ended with more than just the collapse of Archegos capital management. It ended an illusion, the illusion that private wealth, no matter how vast, could bend markets to its will indefinitely. Bill Hwang learned what every market manipulator eventually learns: That prices based on artificial demand are fragile, that leverage amplifies losses as much as gains, that lies to lenders have consequences, that markets, in the end, are bigger than any single player. But the damage was real. Careers destroyed, fortunes lost, trust eroded. The prime brokers who enabled Hwang's scheme faced years of congressional hearings and regulatory scrutiny. Their shareholders absorbed billions in losses. Their employees faced layoffs and investigations. The employees at Archegos itself, the traders and analysts and support staff who thought they worked for a successful family office, found themselves unemployed and unemployable, tainted by association with one of the largest market manipulation schemes in history. The ripple effects spread far beyond Wall Street. Pension funds that owned ViacomCBS and Discovery shares saw their holdings lose value as artificially inflated prices collapsed. Individual investors who'd bought into the rising market discovered they'd been manipulated. Employees of the media companies watched their stock options lose value as the truth emerged. And somewhere in Tenafly, New Jersey, a 60-year-old man sits in federal prison, serving 18 years for believing he could outsmart the markets, for thinking that enough money and enough leverage and enough lies could suspend the laws of supply and demand. The markets have moved on. ViacomCBS has been rebranded as Paramount Global. Discovery merged with Warner Media. New stocks rise and fall based on new stories and new manipulations. The cycle continues. But in the quiet corners of trading floors, in the risk management departments of prime brokers, in the family offices of the ultra-wealthy, people still whisper about Archegos, about how quickly $36 billion can disappear, about how thin the line is between genius and fraud, about how even the wealthiest, even the most sophisticated, can lose everything in 48 hours. The lesson of Archegos isn't complicated. Markets can be manipulated, prices can be inflated, reality can be postponed. But not forever, never forever. Gravity, in markets as in physics, always wins in the end. Whether that's a comforting thought or a terrifying one, whether it represents justice or simply the cold mechanics of capitalism, whether Bill Hwang was a criminal mastermind or just another gambler who bet too much and lost too big, well, but we will let you be the judge of that. Leave your thoughts in the comments. Join us next week for another story from the dark side of the markets, and sleep well tonight.